Hello, chart watchers, and welcome to this Wednesday, April 25th Market Watchers live show with your hosts, Tom Bowley and Erin Swinland. For those of you joining us for the first time today, welcome to the show. You picked a great one. And for our regulars, welcome back. Well, the selling that we saw yesterday seems to be picking up a little bit of steam here today now. We got the Dow Jones Industrial Average down 118 points, the S&P 500 down 11. The NASDAQ is down 23 after being down quite a bit more earlier. The Russell 2000 also down almost 7 points today. 10-year Treasury yield has moved above 3%, and it is holding at this point at 3.02%. Volatility index on the rise, really had a big move yesterday, held recent support at about 14.5 from back in early March, and we are on the rise again here in volatility. That's not good news for the bulls. Materials, best performing sector, up a little bit more than 0.1%. The XLY, consumer discretionary, also clinging to a small gain. RHI, Robert Half International, came out with earnings, and that is leading the Business Training and Employment Agencies group higher. Financial struggling today, which is a little bit of a surprise given the higher Treasury yields, but we are down on the financials. That is the worst performing sector. Real estate services, yesterday we talked about the fact it was trying to make a breakout. Look at that tail that it left up there, and now we are seeing the exact opposite. Real estate services down more than 3% today. And GE, we've been giving GE some love lately. Last week, made a big move up for the week, went all the way back, filled the gap from back in mid-March. Well, now it's pulled back, and now it's got a short-term gap that it's filling to the downside. So GE, the worst performing stock in the Dow and the second worst performer in the S&P 500 today. And with that, let me bring in my co-host, Erin. How are you doing this morning, Erin? And we're not getting you yet.
I'm here. I just wake up a little bit, Erin. Beautiful weather here. I can talk about the weather all day. We don't need to talk about hockey because I can always win the weather discussion being in Southern California.
You can, and all year long you've been beating me in that regard, no doubt about it. But it is nice here in the Southeast today. Got a warm day shaping up, sunny, 75. Should be a nice one finally. I think Sprinter is officially over, and we're actually moving into spring here.
Yes. Time for me to start following the Angels baseball a little more closely now.
Well, we do have a special guest in here today, Gatis Roze. Gatis, you're up in the upper Northwest. How is the weather out there?
Well, it was considering driving the convertible today, but then driving stick shift around Seattle during rush hour is not my idea of a good time. But yes, sensational day. But this is always a bait and switch thing here. We have a week or two, and then May hits and we get more rain again. So
yeah.
No complaints.
Yeah, I was going to say, we don't give the traffic forecast on here too often. I'm not even going to try to compete with Erin on this one.
Yeah, that one I would definitely be the loser.
He's down in LA in that area, so there's no way I'm competing with that. I used to have an argument when I was in Washington, D.C. for quite a few years.
Oh, heck yeah.
Yeah, now down here in South Carolina, no. I think Southern Cal is just a little different than South Carolina. But anyway,
yes,
I do have to say, Gatis, it's great having you on the show. We've been trying to get you on the show for quite some time, and this is your first appearance, and we're really looking forward to your presentation later in the show.
Well, I have been stuck in traffic for 3 weeks, so I'm pleased to be here.
There you go. We're going to get back to Gatis here in about 10, 12 minutes or so. But Erin, why don't we go ahead and get started, go through the announcements, the agenda, and then we'll bring Gatis back in just a bit.
Absolutely. So for the rest of the week, I have a workshop tomorrow on moving averages. I'll give you a refresher on those, maybe teach you something you didn't know. And then we have everything stock charts on Friday, so you don't want to miss that either. And as far as today's agenda, of course, we just introduced Gatis. He's going to be here giving us a presentation. Can't wait to see that. 10 and 10 to 1. Our very first symbol is going to be Cameco Corp, CCJ. So if you want to go look at that chart in preparation for the 10 and 10, go right ahead. And instead of doing chart breakouts like we normally have set up for today, we decided we would do chart breakdowns because of what's been going on in the market. And I'll get to show you my PMO scan for dogs, those that don't look so good. So I'm excited to share that with you.
Very cool. It is kind of different. We haven't talked too much about chart breakdowns, and this in no way suggests that I think that we're in a bear market. And I don't believe you feel that way as well. But we have been seeing a lot of weakness. We got volatility picking up, and I think probably all the bears that are out there listening are saying it's about time you all talk a little bit about some of the things that are going wrong, that's going wrong with the market. So that'll be a segment for sure. All right, let me go ahead and get into the technical news so we can get back with Gatis here shortly. I do want to point out there was really little economic news. We're under a barrage of earnings reports, but not a whole lot going on in terms of economic news today. So the 10-year Treasury yield and the bond market kind of trading off of technicals at this point. And you can see that the uptrend in the TNX continues here in the short term. This has been a huge move here in the month of April to the upside. 2.72% was the low back on the first day of the month. And here we are now climbing above 3% for the first time in 4 years. And that is spooking a lot of folks. I see a lot of headlines out there talking about higher rates and how that's going to slow down the market's momentum. I don't believe that at all. In fact, normally a rising yield and selling in treasuries leads to money rotating from the bond market into the equity market. So I think a lot remains to be seen there. I do want to point out, though, on this longer term weekly chart, you can see that the 10-year Treasury yield back at the end of 2013 went above 3% a little bit and then failed, got up to about 305. And here we are again, a little more than 4 years later, testing this level again. Now, take a look at what the Treasury yield has done from the bottom. And this was back in the middle part of 2016. And if we pull up the S&P 500 on a weekly basis from the middle of 2016, it has been going along for the ride, although we did have a huge move. I believe we're just consolidating that move, that we're in a correction, not a bear market, but time will tell. I could be wrong, that's for sure. But if we go back and look at the 10-year Treasury yield for the last 21 months or so here on this move to the upside, I want you to take a look at what's happened with bank stocks. The Dow Jones U.S. Banks Index, really from the middle part of 2016, it had been just floundering and immediately took off with Treasury yields. For those of you who don't know, I am a CPA. I worked I was working on the audit side, and I audited banks. And I can tell you that when the Treasury yields are rising, profits do tend to move up very quickly in banks. And that's why you see such outperformance by the banks during this uptrend in Treasury yields. Now, there are a ton of earnings that are starting to come out. We've had a lot of the biggest companies report. We're starting to see some of the second tier, although still some big ones coming out. I know Facebook comes out later. We've got Apple, which I thought reported this week, but actually reports Monday, I think, after the close. So we still have some really big names out there. But for the most part, we're beginning to shift to some of the second tier names, and that'll start to even pick up more next week. But let's go over some of these earnings reports that have come out. First one I want to go over, this came out yesterday, Wynn Resorts. Wynn Resorts, you can see, was making a move up, got up to 195, not too far from the high that it had set back in January. I think remains in an uptrend. They did report better than expected top and bottom line. They beat by just a slight beat on the revenues, 1.72 billion. Market expecting 1.71 billion, but their beat on the bottom line was pretty solid, $2.30 versus $1.96. But the market doesn't seem to care, and we're seeing a lot of this right now, partly because of the huge run-up last year into the early part of this year. I think a lot of really good news has been built in, and I think that's why the market continues to consolidate. And then we just keep coming up with different topics and different news stories to justify the selling, when, in my opinion, it's just the fact that the market ran up so much. Consolidation is normal. Wynn Resorts, though, you can see has gapped down today. It's down more than 4%. It is struggling from a technical perspective. We still got that overhead resistance to clear from January. And to the downside, you've got gap support from back in the second week of March, somewhere around the 173 level. We've gone back and we've tested that. I wouldn't be surprised if the market continues to consolidate if Wynn makes its way back down to that level. I still like the company, though. I like the chart, and especially like the fact that they beat top and bottom line. Texas Instruments. We were talking about this one yesterday. They reported in the chip space. Let's see if I can get this to come up. There we go. They reported in the chip space. I do not like this candle at all. It was up nicely earlier today, went up into this gap resistance zone, has failed. We are now back below the 20-day moving average. And anytime I get these false moves above the 20 and then come back down, makes me a little nervous. And just overall, the chip stocks have been struggling. If we pull this up on a relative chart, you'll see here is the 1-year chart of Texas Instruments. Major support back here at about 97.5, which is where we were yesterday. You can see that the semiconductors continuing to move higher. One thing that was odd, though, is that Texas Instruments relative to the semis was underperforming for 3 months leading up to the report today. So maybe we got a little bit of a relief rally with the move earlier, but I don't like that move again beneath that 20-day moving average. If we can't close back up above that, it looks to me like maybe we're setting up for another move back down to test 97.5. Let's see, we've got a few more reports I'd like to look at. Checkpoint, CHKP. This isn't one of the bigger companies out there, but I thought it was very interesting to point out because we did get a gap down on Checkpoint, even though we had an earnings beat, 130 versus 128 on the bottom line. They did come up just slightly short on revenues, 452.3 million. Market was expecting 452.7 million. And again, if I pull this one up on a relative chart, I think this looks interesting and it's kind of a lesson for everyone out there. Checkpoint is in the software space, and we've talked a lot about software and how strong this group has been. But when you look at Checkpoint relative to the software stocks, it has been a major laggard, and that has been consistent for the last several months. So I think what that's telling me is that the market wasn't really trusting this report and Checkpoint in general. And that's even though software on a relative basis has been outperforming the S&P 500 rather handily over the past several months. Checkpoint was one of the weaker stocks within this space. They did not deliver the results, and you can see the huge gap down that we saw. Now, perhaps this hollow candle, if it holds into the close, will mark a significant bottom. But from now, that relative strength, or in this case, relative weakness, would have me concerned. Boeing, big aerospace company, of course, out in the Seattle area. Boeing did come out with some very nice results. Top line, 23.38 billion revenues. Market only expecting 22.32 billion. So a nice beat on the top line. Bottom line, they blew the numbers away, 364 versus 259, and they raised guidance. And for all of that, we've got a 1.48% increase or move higher today. And that was after we had been up much higher early in the session, about $10 higher. We pierced the 344 level. But you can see 340, 345 in this area has been difficult for Boeing. So I think even though they've got great results here, it looks to me like Boeing wants to consolidate some more. I would not be surprised to see this 310, 320 area potentially come into play, although I do like Boeing. I think that the longer this consolidates and the more it pulls back, the more I like it on a reward to risk basis. NSC, let's pull up NSC, which is Norfolk Southern. Norfolk Southern had a nice report, 2.72 billion on the top line, market expecting 2.68 billion. Bottom line, about a 10% beat, $1.93 per share, and the market only expecting $1.77. So a nice move here. Does appear to be breaking a trend line, really nice volume coming in, but this is another one that's leaving a long tail at the top. We saw this yesterday with Caterpillar and a number of other stocks where we gapped up or at least started off okay, and then we sold off all day long, closing way off the earlier highs. And I'm seeing a lot of that again today. So it's just telling me the market looks like it's still not quite ready to move higher, and we're looking at more consolidation potentially ahead, at least in the near term. Again, if we pull up the NSC chart on a relative chart that I like to use, you can see here is that downtrend. I do like this candle. If it finished strong today, that would be nice. Railroads continuing to perform okay on an absolute basis. NSC coming into this report, though, had been underperforming the railroads by quite a bit. You can look at this downtrend, even though railroads were going sideways. And so, again, not a whole lot expected there. Maybe we do leave that long tail to the top, false breakout, or at least a false test there of overhead resistance as we move back down. And the railroad group as a group relative to the S&P 500 actually making a pretty nice breakout here. So I think it's going to come down to how Norfolk Southern finishes the day. If we can finish with a strong rally, finish with a hollow candle, I think this downtrend could end, and maybe we'll start to see some outperformance in a stock that has been underperforming for a while. It is in a nice group on a relative basis, the railroads. Let's take a look at one more real quick. Amgen. I'm going to go ahead and just pull it up here on this relative chart. Amgen did beat on its top line, $5.55 billion versus $5.46 billion. It beat on the bottom line, $347 versus $323, and it is down a penny. That's what the market thinks of this report. Again, you can see biotechs have been weak the last 3 months. Amgen, though, on a relative basis, has been pretty strong. So if the biotechs in general could start to make a little bit of a move, we might see Amgen bounce off of what should be pretty good support in this 165 to 170 area. And with that, let me go ahead and bring in our special guest, Gatis Roze. Welcome back, Gatis. I know you got a lot of good stuff ready for us, and we're going to let you take it away.
Well, the best stuff was I came in with my castanets and then realized this isn't a live TV show. It's just a PowerPoint presentation. So you guys are going to miss out on the castanets. But in any event, this the title of, I have two titles for my brief presentation today. The first title is The Two Pillars of Probability Enhancement. So I'm a big proponent of everything and anything we can do to increase our probabilities of success as investors. And then the other part of the title was How to Systematically Reduce Risk and Increase Your Rewards. And I'm going to actually show you how you can do that. So we're going to be nudging probabilities. That's really what we're into with this little presentation. I feel a little bit like an entrepreneur that gets on an elevator with a venture capitalist, and the venture capitalist says, well, okay, tell me all about your company. You've got 30 seconds. Well, I'm going to try to compress 25 years of investing here into 20 slides. So it's one of those situations. We'll do the best I can. The only reason I'm putting up the bio really is that I wanted to say I started 4 successful companies before, including a NASDAQ traded equity. I retired when I was 40, and I've been managing my own money since that time, without, let me emphasize that, without the distraction of clients. So for many of you out there listening, I'm very much like you. I'm an individual investor. I've been that way. The teaching thing sort of a philanthropic gig. So the first pillar I'd like to talk to you about today is I'm using the metaphor of Russian nesting dolls. And the metaphor here is because the riches are in the smallest doll. So we start here with the big picture, which are, and I'll explain this a little bit later, the 59 asset classes that we're going to talk about. Then the second doll is your own personal portfolio of whether it's 5 to 20 asset classes, whatever you feel is manageable. And then, of course, the core and explore doll, which talks about core being John Bogle's asset protection part of your portfolio, and then the explore part being asset growth. And then we go on to the core, the smallest doll, which is how to get the best of the breed, whether we're buying stocks or ETFs or mutual funds. This is a slide directly from our book Grayson and I wrote a few years ago. And quite often we hear readers tell us that this is one of the key takeaways from the book. These are 59 unique asset classes. When you consider there's over 5,000 ETFs, each claiming to have some sort of unique approach to the market, Morningstar has hundreds of asset classes. For us to pull them down to 15, and there really aren't 59, and there really aren't any gaps here. So notice too, we're going to focus a little bit on correlations, but consider this as sort of a buffet, a plate for you to walk through these asset classes and pick up a balanced portfolio. That's really what we're after, what we're doing. In the recent chart pack, for those of you that are familiar, we've actually replaced 11 of these ETFs with new improved champions, if you will. This is another slide from the book, but these are the market stages. The graph is to take you through the historical reality of markets, and markets they cycle through these things. Asset allocation really is all about prospering in every type of market through all types of cycles. And you got to build your portfolio to embrace this reality. That's really why this slide is up here. Let me explain the format. I'm going to give you, show you a blog that you can go and revisit. These are the key points from the blog. So we'll explain that first. These are blogs from our Traders Journal blogs. So they'll follow with a slide with the actual blog title and date, so you can easily find it on stockcharts.com. But the second nesting doll concerns itself with building a portfolio. So in this blog, I put together, just intuitively, I built a sample of 6 asset classes, and you'll see those in a bit. Personally, I have 20 asset classes, but appreciate this is my full-time job, and I've been doing it a long time. So perhaps 20 is too much. But in the examples, the 3 example model portfolios, what I was trying to get across was that if you had a portfolio of 6 asset classes, one strategy is an equal weighted one where you put 16.5% equally across 6 asset classes. The strategic one is where you put anywhere from 5 to 40% in each of the 6 asset classes. And then tactical is where you're constantly shifting. You might be 5 to 40%, but you vary that from year to year. So this is the blog. I would really encourage you to look at the comments at the end that one of the readers wrote up. I thought Kumar, these are his numbers, but I would encourage you to look at Kumar's comments, because he said this was a case where we actually, all 3 of these portfolios beat the benchmark, and they had less of a drawdown than the market. So per his calculations, this is a free lunch. We had a higher reward for less risk. So we all want to jump on that if we can find it. This next blog I'm going to show you is simply trying to pitch you that asset allocation decisions they may not be the sexiest to go to a cocktail party and say, gosh, I bought XBI. You'd want to say, well, maybe I bought Tom's Amgen or whatever. But you constantly have to pick between, if one of your asset classes is, let's say, a biotech, you have to pick between the best mutual funds or the best ETFs, or you can certainly pick stocks as well. This blog was interesting in the sense that only 50% of my own assets are in ETFs. The other 50%, the best of breed, are mutual funds. So in mid caps, for example, I have mutual funds that top all the best ETFs. In biotech, I choose to play biotech using XBI, which tops all the other mutual funds. Balanced funds, mutual funds won. For emerging markets, ETFs won. So the key is to maintain the best of breed, whatever asset class you're looking at, and understand that you're shifting and always changing, because these things, the best of breed changes, and then you may decide to drop an asset class. But you should maintain the champion. The champion will change over time, and it depends on what your time frame. One of the things that Grayson and I are always talking about is, what's your time frame? If you're at a cocktail party talking to a day trader, that's very different than talking to a long-term investor. So the first question you ask a person is not necessarily, "Hi, Tom. Tell me a little bit about your time frame." It's that kind of thing. We actually, when Grayson and I wrote our book, and Wiley did not have room for this asset allocation DVD that we put together. We were hoping it would go in the back of the book, but they said it would become too expensive. So it sort of broke my heart. But anyway, the DVD's available at Stock Charts bookstore. On to the second pillar. And I like to say, let the winds of probability enhance your investing success. Here we have a situation where I'm using the metaphor of nesting tables. And the largest table, obviously, being the asking yourself, what is the market trend? What should the allocations be? And then looking at the strongest sector, the strongest industry, and back down to the strongest stock in each of those. So think of it as we're constantly nudging probabilities, and it's really all about discipline. And this, in a nutshell, is really what the tensile trading approach is about. So we're asking ourselves, what's the trend? The allocation is it a large cap, mid cap, or small cap market? Is it a growth or value market, or is it an international or domestic market? So, and again, understanding your own time frame, and then we move on to the sectors and the Dow industries, and then the best in stock. So in our book, we use this metaphor, but I've just for spicing up the presentation, this metaphor, obviously, you score points even through one hoop. You do not have to go all the way to the very bottom to score points. So you can actually play the market in an uptrending market, or pick the sector, or stop at picking an industry group. You don't have to pick individual stocks. I pick individual stocks in one asset class, which is large cap stocks, large cap US stocks. The rest, I'm invested across a spectrum of, I use ETFs and mutual funds. And it has worked nicely for me over the years. Don't try this with a 2-leg or 3-leg table, but in other words, without a process or an organization, some people call it a process or whatever, we refer to it as routines. Without routines, you're going to waste time, you're going to be inconsistent, you're going to miss opportunities. So if you aren't an organized kind of person, I would venture to say or submit to you that probably you're not going to be consistent. You probably should not be involved in the market. Terrible thing to say, but this is the chart pack that we just put out. And back in 2011, I began giving this to my students. It was the chart lists of my own that they could just download, and they were all pre-populated. Since 2013, we've actually gotten a whole community of users that are involved in this and updating it. And this is our 19th update. So today, stockcharts.com users can download 96 chart lists. They're all pre-populated. It's all formatted. It's all organized. I can't guess how many thousands of hours this is, but it's the ultimate probability enhancer. Let me call it that. This is an example from the chart list, but it addresses back to the pillar number 2, which was the top table. There are lots of cliches out there, but let's say, the rising tide and all that. But the bottom line is you've got to answer the question, what's the trend of the market? Is it either up, sideways, or down? And then to increase your probabilities, you've got to answer the allocation ones that I mentioned earlier. So these are all about building probabilities. And obviously, you're not going to buy in a down market or buy value in a growth market. It's that kind of thing. And that's what these chart lists are designed to do, to answer. So let's take it, let's assume that you are a buyer in this market. It's questionable, but this was a perf chart of the S&P sectors. This is table number 2. You'll see that here we have the sector that is performing best is energy. So with one click, you've answered that energy is the most attractive over the last, and assuming your time frame is 23 days or so, you're that kind of trader. So with one click, you've answered the question, which sector is the best? Where should I have my money? You could stop here. You don't need to go deeper, but let's go dig a little deeper. If you click the energy sector, you get this is another view. It's just simply a matrix. So remember, the market is a big pie that's cut up into these 9 slices. It's the same market. Different people cut it up different way, Russell and Dow and S&P. But basically, that's what we're doing. We're doing the big pie cut first. And in this case, we're showing even the matrix is supporting the fact that the energy sector is the most attractive. Table number 3 is we're looking at the industries that make up the energy sector. So in the case of energy, there are 6 Dow industry groups that are distinctive, that make up this big pie. Which is the most attractive? Well, we can see very quickly that exploration and production. So with another click, we go to the 4th part of the table. Which are the stocks in that industry group in a strong sector that are most attractive? And from this, I went through a couple of these very quickly, and I just happened to pick this company. And you'll see that the first chart, the blue one on the top, is showing you how is this company doing relative to the market. And you can see it's outperforming the market. The green line is simply showing how is the sector, which we've discussed already, how is it performing relative to the market. And I use, unlike many people, I do not use the S&P 500. I use VTI, the Vanguard Total Market. So I'm comparing it to the total market. The third graph below is asking the question, how is the industry group that my stock belongs to doing relative to the sector? And you can see that this is a stock that is an industry that is outperforming its sector. And then the bottom 4th chart is showing you how is the stock relative to its brothers and sisters in the industry that it belongs to. This, you might say, oh my gosh, how could I draw this? Well, it's very easy. If you go to chart styles and you pull down, go to predefined settings, go to the very bottom, you end up with my name, Bob Schwartz, and you just use Gatis Roze, pull that up, and you get that that format. So as I mentioned earlier, sort of as a philanthropic gig, I've been teaching for 18 years now, and I calculated over 5,000 investors. And the two, I mean, there are a lot of things that go into this, but the 2 overriding observations, if you will, that I've made to summarize is that you need a personal methodology. Now, I've just showed you very quickly the nesting tables is the methodology that Grayson and I wrote about in our book. And then 2 is you need an organizational process. And in the case here that I was showing you, that process is the chart pack. That is how you grow your portfolio, you grow your wealth. It does take, those are the 2 essentials. So in summary, we've got the Russian dolls representing an asset allocation focus. We have the nested tables representing a methodology. And you wrap that all up into an organized process. And yes, indeed, it is possible to reduce our risks. We nudge our probabilities up ever so slightly with each attribute that we use, and we grow our returns. So it's, was that fast enough? I know some of you will complain. It's like standing in front of a fire hydrant getting a drink, but in any event, for the full sort of 10-stage detailed roadmap, you can go to stockcharts.com bookstore. And the advantage of buying the book here is it's cheaper than Amazon, but it's also signed by Grayson and I. So you get that benefit. And then lastly, if you're into a truly completely transformational experience, you can join Grayson and I for a weekend in my office. For May 19th and 20th, just go to our website, which is Stock Market Mastery, stockmarketmastery.com, which we just trademarked, which we're very proud of. So Thank you all for joining me. Thank you for reading my blog and supporting the Traders Journal blog. And I understand we're going to open it up for questions at this point.
Yeah, I don't know, Erin, if you've been following on the in the chat room, but are there any specific questions, or maybe can you summarize any questions?
Sure. There actually, it's one of those when Gatis speaks, people listen, because there was really one main question, and it was about so do the gains of owning mutual funds outweigh the transaction fees of an ETF for like assets? Was what the question was.
Please go back and read that Best of Breed blog that I wrote about. I think the title was that, understand, I have 20 asset classes. They're split between a core and explore. And as I mentioned earlier, core is where you're protecting your assets, and explore is the growth part. I have something called Super Explorer, which is an asset class, large cap stocks like Amazon and Visa that I own, that I'm really going for growth. It's my trading account. The other 19 asset classes that I cover, half of them I choose to, the best of the breed is an ETF, and the other half are mutual funds. And if you look at something like, I mentioned in the article in the blog, I mentioned biotech. I feel of all the ETFs out there, XBI is the way that I want to play biotech. Tom, I loved your Amgen, but I choose not to do biotech. I choose to make biotech an asset class, which I believe, 10 years from now, I'll be rewarded for. I'm not going to worry about the ups and downs. But there are good mutual funds out there. But in that case, that asset class, the ETF is best. For mid-cap stocks, I've used a prime cap fund. You can look that up. It's actually in the blog. It has outperformed everything and anything in the mid-cap area. And yes, it has modest fees, but its performance, if you're going to get the performance, I'm happy to pay the fees. So that's the bottom line. If you're not getting the performance, then, buy the ETF. But it's a case-by-case, asset class by asset class situation. You cannot, don't be hoodwinked by the press to say, oh, you just have to buy ETFs. It's wrong. Please read that blog. I think the light will go on. You'll see what I mean.
We did have somebody ask if you're going to offer that course that you're showing there in any other cities other than Seattle.
I'm on the downside of my, I have a Medicare card. I just booked a nice trip to France with my wife. I'm not, you can talk to Grayson about that. That's not I'm doing less and less as opposed to more and more, because you have to understand, I said this in the Stocks and Commodities magazine article that they interviewed Grayson and I, and really my objective over the last 15 years was not to sort of, it sounds a little corny, cliche-ish, but it was not to leave a legacy for my son. It was to leave a legacy in my son. And I think I've done that. He's my best student. And that's really all a dad can ask for. And so I've done that. My job's done. I'm off to Hawaii.
Sounds like Carl and I.
I thought you were off to France.
Yeah, France too. Hawaii is my happy place. France, my roommate at Stanford is a Frenchman, and who used to run GE Capital, ironically, in Europe. So I'm going to visit him. He just bought a place in Corsica. So
that's beautiful.
Hopefully that'll be my happy place. So any more questions?
Oh, yes. They're now just flying in. So how do you decide when to buy? Do you wait until it becomes a top performer, or are you trying to get in early?
I wrote a blog about my trades, the FANG. I traded all four of the FANGs, and I wrote a blog about this. If you just Google Traders Journal FANG stocks, it's in the title. And I show you exactly when I bought into those. Basically, it's a matter of aligning. And in all those cases, the four major probabilities, back to the nesting table, we were in an uptrending market. They were in the best sector. I picked the strongest sector. They were in the strongest industry group, and they were the strongest stocks in the strongest industry in an uptrending, in the strongest sector in an uptrending market. That's what I'm talking about, aligning your probabilities. And it's a very simple concept that, of course, we spent 300 pages in the book describing, but that's really the objective. It's those little, if you can nudge those little probabilities, they all add up to something pretty phenomenal.
Hey, Gatis, just to kind of follow up on that. So if you're looking at an industry group, and the industry group has pulled back to, say, a long-term uptrend line that looks good technically, but recently has not been one of the best areas, would you look at it during that pullback, or do you wait until it actually makes that move and begins to show relative outperformance again?
I'm looking for outperformance. I will tell you that I'm a man out of control when it comes to watch lists. I'm a bit of a, I have a friend of mine, Harvey Baraban, and we joke we're just stock market junkies. So, and my wife claims I'm the world's worst retiree, because this is just it's a genetic problem with me. I think I just enjoy the market. So I love having an extensive watch list is perfectly fine, but I will wait for the train to start to move. I'm not looking to get on a train that isn't moving. Mm-hmm. Now understand, there are sort of three separate portfolios that I trade. I have my core VTI, Vanguard Total Index, being an example. I don't trade VTI. That's where I park money. Vanguard Healthcare is a fund I've owned for 25 years. I can't afford to sell it because of the huge capital gains in it. Is it the best fund? No, but it's fine. And then I have my Explorer, which I would call the biotech. XBI is an example of that. And then I have my Super Explorer stocks, which are the individual stocks like, I mentioned Visa and MasterCard and Amazon and those sorts of things that I trade.
Now, when you look at some of those stocks, I mean, you just mentioned some stocks that have obviously done very well over the years. What would trigger you to sell one of those companies? I mean, we've been going through so much volatility, and I think, all of our listeners and everyone who trades in the stock market, I mean, the toughest part, when your stocks are going up, it's easy. I mean, of course, you're just going to hold on, you're going to make money. But when you go through a period like we have for the last 2 or 3 months, and, these crazy swings out of nowhere, all of a sudden with the volatility as high as it's been, how do you mentally get through periods like this? I mean, what would need to happen for you to sell something like an Amazon?
I did actually take a chunk of money and sell Amazon and buy another stupid car that it's another weakness of mine. But as I said, I'm a man with no control.
What was the reason? Why did you sell some Amazon?
Because it got to be, I've owned it for 10 years. So does that answer your question?
Okay. Yeah, that does answer.
We joke about it. It's a matter of balancing a portfolio, looking at the gorillas. You have to, put the gorillas in control occasionally. And that is one of not to pitch seasonality, but I think seasonality is a great tool to help you balance your portfolio and get it back to the percentages that make sense. And I'm a big proponent. I hope all of you answer the quiz that the question that was posed before we started about what percentage of your time as an investor do you spend on asset allocation. And it was interesting. The early goings were showing that it was sort of 20%, when it should actually be the opposite. Well, here we have it, 62%. It should actually be the opposite. It should be 80% of your time should be spent on focusing on asset allocation. It's the highest leveraged activity. That's why, I know I'm sounding like a preacher, but that's why we put together that 6-hour sermon on the DVD, and we wanted to include it in the book, because it truly, for individual investors, it is a very, very powerful, high leveraged activity. Is it sexy? No. To go to a cocktail party and say, oh, I'm using seasonality to manage my asset classes, I mean, nobody's going to want to talk to you, and you'll be in the corner drinking wine by yourself. So there's my pitch on asset allocation.
I always joke about that because I guess I do look at myself sometimes as being a geek because I really I love the stock market. When I go on vacation, I still write my blog every day. And
welcome to the club.
Yeah, I mean, Erin and I were talking about this yesterday, and she's like, "No, I just want to get away." And I said, I just love the market. So even when I'm on vacation, it's still something I really enjoy doing. I mean, every once in a while, especially when the volatility gets out of control, I just want to step away from the market for a little bit. But for the most part, I know exactly what you're saying. It's something that I enjoy talking about. And I'm sure on many occasions, eyes have rolled back in the back of people's heads, and they're just like, all right, let's get away from this guy.
Tom, I will tell you, I've written blogs about this. Some of the best months of trading over the last 25 years have been in Hawaii. As I said, it's my happy place. I go every year, and I can't explain it. I go to Hawaii, and I just seem to relax, and I'm in touch. I'm channeling the market, and I've had some amazing trading adventures, investing adventures while being in Hawaii. So I think everybody should move to Hawaii and relax.
Well, I don't think we'll be bringing you in as a guest if you're in Hawaii. What time is that? Like,
yes,
middle of the morning. Is it like early morning?
Well, Grayson can actually tell you the story. We were actually in Hawaii during the Facebook IPO, and I do not advocate buying IPOs, but Facebook was sort of an exception. And it was trying to get, if any of you have purchased IPOs through your brokers, and we were using multiple brokerages and all trying to get forms done, signed and delivered and approved and all that at 3 a.m. Hawaii time. Yeah, Hawaii has its advantages. It has its disadvantages.
I always thought I'd love to move there because the market closes so early and I could finish up everything nice and early.
Two-edged sword.
Yeah, well, I do have, we talk about ChartCon on here pretty frequently, and I thought your talk today was pretty timely. Talking about risk and using asset allocation and so forth to help manage risk. And I know you've got a talk coming up in Seattle in August. We're looking forward to getting together again.
I think it's the last time I saw you two belly to belly was yes. Which is a special pleasure about ChartCon from a speaker standpoint, is to get together with you guys and other speakers, because generally I'm working in a trading office by myself, and I mean, it's nice, and yes, I have a Starbucks wife and that sort of thing. Is just kidding, but I mean it is fun to go and spend time with Greg Morris and Martin Pring and all these people, and Julius. That's special.
Yeah, and where else can you go? Sit down at a bar, have a beer, and talk about the stock market. Have people on the other side very receptive.
Exactly. I think I enjoy that more than anything, is just being able to sit down and talk about what everybody's doing, and hey, I'm doing this way, and what do you think? Well, I do it this way, and I think this, and it's a lot of fun and actually a learning experience, I think.
Well, you guys are sophisticated, and it's really nice to get in a little more depth than perhaps I get into with my classes. Because it's one thing to talk to Tom and Erin, it's another to be talking to 150 people, individual investors in the class. So it's a special pleasure for me. Thank you, Tom. Thank you, Erin. I appreciate the time together.
Well, we appreciate having you come on here. Now, maybe if you could give a little bit of a sneak preview as to your talk. I'd
have to shoot you. I'm sorry.
No, you're not helping here, Gatis. Reduce risk by crafting your asset allocation profile. You're going to have more than 15 or 20 minutes when you go to ChartCon. Is that going to be, is someone going to be able to listen to that and be able to apply some of your techniques into creating their own portfolio?
I think after today's presentation, something that I've realized just sitting here talking to you guys is I think I need to blend two types of presentations. One is the canned slides that we just went through, but then to be live and be able to shuttle you through very quickly to show you, look, here are the Here's how you get to the best sectors. Here's how you get to the best industries. Here's how I find the best stocks. Here's how you get the Gatis Roze chart style with one click. A lot of it is saving time. I know when we do our boot camp, the last boot camp we had, it was amazing because people were so blown away. I was actually blown away because I've been using stock charts for a long time. And to have Grayson there showing people how to speed things up. And the whole chart pack is designed to maximize the amount of information you pull out of the market and just be able to minimize your time. And so I'd like to show some of the things, the shortcuts, if you will, that you can do very easily to find great stocks and find great asset classes, whether they're ETFs or mutual funds, and rock and roll.
Well, it has certainly been a pleasure, and it's been way, way, way too long getting you on here on the show. So we got to make sure you get back in here maybe one of these days when you're not in France, you're not in Hawaii.
Yeah.
Try and get you back on.
Consider that an invitation. Thank you, Tom.
No, we've really enjoyed it, and I know our all of our visitors and so forth have really enjoyed your presentation today, and I know I really look forward to seeing you.
Likewise.
Should be a good time. All right. Today's 10 and 10.
Yeah, so there he goes. That was a very interesting presentation. And it's different than a lot of the others that we've had on here. I think, I'm probably among the shortest term traders at stock charts. I mean, I think Arthur gets into trading a little bit more, and I know Greg gets into trading a little bit more, but I'm definitely on the shorter end in terms of how long I hold positions. It's nice to hear from someone like Gatis who takes a different approach, very successful approach, and he's willing to share, what he does in looking at the stock market and the bond market, all the different asset classes, and so forth. So it was great hearing from Gatis.
Absolutely. Very much enjoyed that. I'm going to probably rewatch it. I suspect a lot of other people will too. All righties.
For the 10 and 10.
Yep, let's take a peek here. I'm filling out our RRG chart right now. Some of these outliers could be interesting. I don't know if I'll be choosing them, but something to look at. And, I always like to see what we've got going in sectors and industries. And look at what we see here. Lots of healthcare and industrials right now. Generally, it's almost all tech and finance. So I think it's, and a lot of cyclicals, which we still have. But to see this huge, interest in the industrials, healthcare, and materials, I think is very interesting.
Mm-hmm.
All right, so our first one is CCJ, Cameco Corp. And everybody get your likes in because the next one is going to be the most popular request by likes in the chat room.
All right, let me go ahead and pull chart up and we will get started. I actually like the chart. It did recently fail at overhead resistance and is pulling back, but I do think that it looks pretty good. And I think clearly on a relative basis, we have a stock that's performing really well because we are up near recent highs. And of course, the overall market is nowhere near that. So you can see the heavy volume that came in on April 16th. So again, if I'm annotating and I'm putting this into a watch list, and I thought it was very interesting that Gatis was mentioning that he has a ton of stocks that he continues to monitor. I think that's a great idea as whether you're a short-term trader or long-term trader, take advantage of what stock charts has to offer. Being able to keep these various watch lists and so forth and keeping annotations and some of the things that look interesting. I think that all of that is really important in your trading and or investing success. But I think that we're kind of in this range right now, a pretty narrow range between about $10 to the downside and maybe $10.60 to the upside. Clearly that $10.60 level is big. We've been up there a couple of times, haven't been able to close from. So from more of an intermediate term perspective, I think that's your key resistance. Short term, I think this pullback could present some nice opportunities as we get down to this 20-day moving average, because again, this is something, I don't know why that just did that to me, but every once in a while that does that, and I don't quite know why. Let me go ahead and just save this, and we'll come back and look at it in a minute. But the key for me is that 20-day moving average to the downside. I think as long as that continues to hold, then I am okay with CCJ in the short term.
All righty. And the winner is, for the second symbol, is actually QQQ.
Oh, wow.
Yeah.
Don't do too many ETFs on here. Of course, this is the ETF that tracks the NASDAQ 100. And as long as we continue to hold these lows, you know, we saw the volatility index for the NASDAQ 100, the VXN, spike. And it spiked on both of these lows, got up into the 30s. And normally when you get the VXN moving into the 30s, you do come up with some pretty nice support. Panic just gets a little bit out of control. And then we get a reversal off of that. We are selling now, but we have not gotten down to support. No guarantees that we get there, but I do think 153 on a closing basis is going to be fairly significant. You might go in and maybe say there's a little gap and further support from back in November and December, right around 151.5 to 152. But still, this is an area I think that is clearly a level that we want to continue to hold on the QQQ. I believe we're going to go higher. I think this continues to be consolidation. So my target would still be way up at the highs. I think eventually we'll take them out. But this has not been a very good last 5 or 6 days since we topped. We got into that gap resistance, I think pointed out on both the S&P 500 and on the NASDAQ. And literally we got into that gap resistance zone, turned right back down. So I would even say maybe short term, you could be looking up at about 167 down to about 153.5. That would be my short term trading range.
All right. Let's see. The next one we're going to do is Philip Morris. Tobacco, of course, PM.
Yeah, PM, remember, just a few days ago came out with that horrible, I guess it's been a week now, horrible report. The stock continues to trade lower. Let's take a look at a weekly chart and see if we can find something a little bit. Well, it's trying to put in a bottom at a key area going back 2 years. We had lows that were just below 82, and we've done it again. So I think probably the area that I would annotate here is this is a level we want to see hold. If we fail to hold there, next big low here was probably down around 75. So if we can print some sort of a hammer for this week, maybe we'll get a short-term bounce. Any kind of a bounce, I would be looking now. That's where your breakdown occurred up around 95, 95.5. So if we can hold the 82.5 area, maybe we can bounce and move into this 82.5 to 95 trading range. But still a little early to make that call. Let's see how we finish this week.
Okay. Let's see. The next one I have is CenturyLink, utility, of course, CTL.
All right, this is a longer-term weekly chart. And again, you know, the utilities, I'm not going to be a big fan of. I just, you know, they've been underperforming the S&P 500 for quite some time. And so what I would be looking at, you've got some support there from back in January of 2016. And then the next support was probably at around the 1960 area, which we saw in October 2016 and again in late spring or late first quarter 2017. Once we broke down, you can see where the reaction highs have gone right back up into this range. So I think as we move up on CTL, I think if you get up close to 19 or into the low 19s, I would be leery of this overhead resistance here. The downtrend remains in play. So I would be one, if I was in it, I'd be looking for an exit if we got up close to 19.
All right. The next one is Sally Beauty, SBH.
Sally Beauty Holdings. All right, let's go back to a daily chart here. Sideways consolidation. I'm going to do this one on a relative chart. Let's see what it's doing here. It's been moving down. You can see the specialty retailers have been moving up. So without even looking at it, I can tell you it is not performing well relative to its peers. And there it is, moving down. It has started to come off maybe what looks like relative support. It's been a rough go relative to the S&P 500. So if that's your goal to beat the benchmark index, this has not been a very good stock. So looking at that, I'm not overly excited about the stock. Let me annotate, because when I look at a stock like this, if I owned it and it failed to hold on to what I think is key support, I would be out of it. And for me, you can see the big gap up on heavy volume. We went back down, tested gap support. I'm going to say if SBH loses 15.5, I would want to be out of the stock. I don't like that. And to the upside, we could probably connect some of these prior highs. I don't know, we could do it here. This is why trend lines are so subjective, because I could do that. I also could, let's do a dotted line to make this one stand out a little different. I could connect from there. See what I mean by subjectivity? Really depends on what lines you want to connect. I could even start here and do this and say we just had a breakout. And two other people could draw their lines differently, and you come up with all kinds of different results. So trend lines are very subjective. I think the key to a trend line is the multiple of times that it touches that line. So if you're connecting 2 dots on a chart, it's not very impressive. But if you're connecting 8 or 10, then it starts to become a very significant trend line. But let me get this out of here so we're not too confused by all this. I would just say, maybe looking at this trend line here, knowing that we got support, seems to be squeezing into this range. Let's see which way we break.
All righty. Let's see. FLIR, Flare Defense, I believe. Yes.
Yeah, a number of the defense stocks have been getting hit, even though the reports have been pretty solid. FLIR Systems is continuing to perform really well. It's been a big mover here to the upside. It's not far from a 52-week high. Not too many stocks are saying that right now, especially after the last few days. Defense stocks overall have been strong, and you can see FLIR breaking back out to the upside. It has been a very solid performer within defense stocks. It's been a great relative performer to the S&P, and you can see defense has been performing well versus the S&P. So this is a kind of stock, and I don't want to put words in Gatis's mouth, but you do have a stock that's it's in a very strong area of the market, and it is performing pretty well relative to its peers. I'd like to see a breakout, but the uptrend is clear and undeniable at this point. Maybe to annotate, what I would watch is that uptrend line. So let's just draw that in here. But I'm talking about maybe from here right into here. So it looks like this trend line so far is holding, and overhead, I'd be looking maybe at the recent high. So something like this. So it looks to me like it's squeezing in this range. A breakout above, say, 53, 53 and a quarter would be very bullish.
Okay. The next one is going to be a wheat fund, WEAT.
WEAT. Whoops. Typo. Okay. Well, again, sideways consolidation. I'll be honest, I don't do a whole lot of trading of a wheat fund. So fundamentally, I'm not going to be able to give you a whole lot of help here. I do like the fact that it held 610 on the recent low. So if I'm just drawing this line right across here, you can see we had a support here. We held support in here. A little bit of a back and forth action, but you can see that this area has been key support and resistance on many occasions. So we bounced off of it. We're starting to turn higher, but I see this as more of the trading range, 610 up close to $7, and we're sitting in the 650s. So I just don't see a reason to trade it from a reward to risk standpoint. So I would pass on it, but these are some key levels. As you got closer to 610, I'd feel better about being long. And as we got closer to 7, I'd probably think about taking profits.
All right. The next one is Baytex Energy Corp, Exploration and Production, BTE.
All right, BTE, what's in a good space, and it is obviously a great performer here in the near term. The breakout occurred right here at $3.50. So that definitely was resistance, pretty clear resistance. We broke through it. Look at the volume, has been strong. I just think it's overbought. So again, this is something that I would highlight just as a reminder. I don't like to chase a stock when it's got an RSI reading in the 80s. I think that is a recipe for short-term losses. Nothing saying it can't go higher, but the problem is, where do you set a stop if you get in at 420 when you've got a rising 20-day moving average at 346 and price support at 350? So I would be watching this, and I think if you saw a pullback on BTE and we got it down closer to its 20-day and closer to price support, then I think you can at least manage your trade.
Okay. The next one is FireEye, FEYE, software.
Yeah, this is one that recently tried to make a move to the upside. Actually, it did make the breakout. I was wondering if it made the breakout. And currently, it's got a pretty nice test of the 20-day moving average, rising 20-day. It's got a nice uptrend in play. This is a key area of support. So if I was looking at this and interested, I would be a buyer right where it's at. It's on the 20-day moving average. I think you could probably go in and almost put in a intraday low, or an intraday stop, I should say, but beneath today's low, which is about 32 cents to the downside. So less than 2% risk, and back up to a move where it just topped would present, it looks like maybe about $1 or so. So you're talking about $1 upside and 32 cents downside. So it's better than 3-to-1 reward to risk on the 20-day test. So I like these stocks when they go below the 20-day hold and come back up and close above. So this is one that you could potentially take a shot with.
Okay. And our final one is Cisco, CSCO.
Yeah, Cisco has been a pretty good performer. They normally report the month after everyone else reports earnings. So I think you've probably still got 2 or 3 weeks before their earnings report comes out. But I think you got a move higher. That's your uptrend. A little bit of a cup. I would like to have seen us get up above 45 and put in the right side. I like to get an equal right side to the left side of a cup. But nonetheless, this pullback very similar to FireEye. We got a stock that's uptrending, has been performing pretty well, and is testing its rising 20-day moving average. So I think, again, on this one, I would annotate. And to me, this is a pretty significant test. And you could probably set up some trade very similar to what I just talked about with FireEye. Keep a fairly tight stop, which would be down less than 2%, maybe about 1.5%, 1.25%, 1.5%, looking for a move back up to test overhead resistance, which would be at about 45.5. So you've got what, $2.12 upside and 63-cent downside. So about 4-to-1 reward to risk. I think Cisco looks like an interesting trade.
All right. And that completes the 10 and 10 to 1. And there are your symbols that we covered today. I will have those up in the MarketWatchers live chart list. You can get to that. Just go to our blogs tab, click on the MarketWatchers live blog, and the link to that live chart list is right there at the top of the MarketWatchers live blog. And with that, I think it is time to move into a very quick market update. And then I know we have some really interesting breakdowns to show you. So let's get to that. All righty. So here I thought I'd take a quick peek, first of all, at our candle glance and what's going on. Find it really interesting when I look at the Dow and the S&P, how they continue to try to get into positive territory, but continue to fail at this point. So it'll be interesting to see if they can finally break out. If you want to go with a really obviously short-term chart pattern, I can see these rising triangles, ascending triangles, and those are bullish. So the expectation would be a breakout, but we'll have to see if that comes to fruition. Russell 2000, we're seeing the same problem with the small caps. Canada, TSX is actually in positive territory right now, trading up just slightly. And we can see Treasury yields continue to rise. We're still over that 3% mark after the gap up earlier today above 3%. You can see UUP, big gap up, and is consolidating sideways, forming a bit of a double top here, but I'm not too concerned about that just yet. Commodities are trading in the negative space, in the red for the day. You can see USO started lower and has been managed to get back up, but is just consolidating sideways pretty much near that trading range that formed at the end of yesterday. Gold gap down is now moving sideways as well. Currently GLD reading at 125.31. VIX is higher on the day, reading now over 18.5. And you can see XLU, somebody had an interest in that for 10 and 10. Very interesting, choppy trading going on right now, but down into the negative space. Could possibly be a flag formation going on here for a move up into positive territory. But right now, XLU trading mostly sideways, though very choppy. I'm going to go very quickly to our market summary, and then that will be that. Because I want to look at what our industry groups are doing. Here we go. Let's try that. All right, so as far as sector spiders, we can see materials and consumer discretionary, usually a more aggressive area of the market, doing very well, right up behind materials, up over 0.25%. Financials getting hit the hardest. And we can see that as far as industries go, oil services, chemicals, and hardware right now are the leaders, with airlines and network industries both down, with airlines down over 1% right now. As far as international ETFs, Japan and Singapore, the only two right now trading in the black. And we can see that Austria, Brazil, and the emerging markets ETF, these are the three biggest losers right now as far as the international ETFs that we cover. And with that, I am going to close out our market update. Did you have anything you wanted to add, or should I get right into those chart breakdowns?
Just go right ahead into the chart breakdowns. I think we're good.
All right. Just making sure. I'm going to go to Safari, where I have my scan to show you. So I can't even remember. It was clearly, I know, at least 2 years ago. I wrote a PMO article during what looked like a bear market or a correction mode. And so I selected one of my bullish PMO scans and I turned it into a bearish one. And so that's what I use today to find possible chart breakdowns, those with momentum that are shifting quickly to the downside. And I'm going to just show you very quickly the scan I did. So I originally didn't tighten my universe, and I had like 100 and something come up on this bearish scan. So I went ahead and I decided to move it into the universe of the S&P 500, 600, and the NASDAQ. This is the typical PMO language that I use. I just changed everything from the greater thans to less than and moved my way through that way. So at this point, I'm looking for a PMO that has been traveling downward for 3 days and hasn't had a negative crossover yet. I want the EMAs configured as negatively as possible. So I want the slowest EMA on top with the fastest being on the bottom. And then finally, I decided, well, I don't want to stock it with a scooter in the hot zone. So I want to look for those that have scooters less than 75. And I ran the scan, and I imagine we're going to get, I had about 28, I think, when I ran it earlier today. And I went ahead and just did my candle glance, checked it out, and picked out my favorites. So I will just go very quickly through those and leave you plenty of time to go through yours, Tom. So let's get to my chart list with all of these great dogs. I think the PMO scan article, I called it Scanning for Dogs. And I actually had a picture of my two of my mutts on that article. So these are the ones that I came up with. These are the ones, April 25th. So I have quite a few here. So I'm just going to go very quickly through them. I annotated them already, but they pretty much all say the same thing. And most of them you're getting breakdowns, but the key is looking at the PMO, the price momentum oscillator, and seeing these negative crossovers or these shifts in momentum. And most of these have these tops below the zero line. So when you see a move like that, a top below the zero line, that's telling you there's definitely some internal weakness going on there. And you could see OBV traveling lower. We've got the OBV trending lower with the downtrend that we're seeing here. We've kind of tapped down below this area of support. So we don't actually have a decisive or clear breakdown just yet. But with a lot of these, I went ahead and I had to go look at weekly charts to find support areas. And, we broke down already below this area of support. So I'm looking at the next area of support. We've got a few choices down here, but I think the best choice as far as the most optimistic would bring us down to about 195 on Alliance data. ARNC, Arconic. This one already had the breakdown. We are seeing currently it is trading above that breakdown point, but we have a PMO sell signal actually just about ready to click in. you can see very negative OBV volume. And again, I wanted to go to the weekly chart. I'm just showing you where the support levels lie on these weekly charts. And you can see we're testing an important area of support. So there is still that possibility we could get a bit of a turnaround here. But when you see these very negative EMAs, when you see the very negative PMOs like we're seeing here, the chances are you're going to see a breakdown before you're going to see a bounce. And when I looked at this, I didn't see any really good support until you really got down here to about 16. So I think this one has a lot of downside potential at this point. Charter Communications was another one that came up for me. This one has a double top and it has broken down below that support level. It looks like it's trying to come back and trade just above it, but currently it is, popped down below that, and that double top tells me to expect a downside move of about $20. So I would look for a move down to that 180 level. And again, the PMO topping below zero. And if we look at the weekly chart, we can see that we've already broken down below some very, very important support at about 310. So to me, we're already on our way down. If you want a bit of, like I said, if you want to be optimistic here as far as it not dropping too far, I think 280 would be a possible area of horizontal support. And let's see, let's go back. Dow DuPont, DWDP. And this one, again, we've got we had the breakdown. I wanted to point out that we have a 50, 200-day EMA negative crossover. So that tells me, as far as DP and decision point analysis goes, I just got a long-term sell signal. We have Dow DuPont is now in a bear market, is what that tells me. We also see the 5 cross below that 20. So right now we have the most negative configuration of EMAs that you can have, top below the zero line for the PMO. And at this point, the question is, okay, well, where would your support levels be? Again, I think $61 would be the closest area, but I'm looking at such a negative chart. And again, I'm just popping into that weekly chart for these breakdowns. And you can see that 6250 is very important because it does line up with these previous tops back in early 2017. But when I look at the next areas of really solid support, I think 5750 is your best bet here with that low and the tops we saw here back in the end of 2016. Let's see, almost there. EIG, Employers Holdings. We don't have the breakdown just yet below rising bottoms trend line, but I see that breakdown. I see these EMAs configured negatively. I see this top on the PMO. And although I don't have a breakdown from horizontal support just yet or from rising bottoms, I'm seeing where it can go. I can see that there's a good chance it's going to fall down to 38, and that would still preserve some shorter term to intermediate term support. So I'd be looking for a drop down to 38 on EIG. Goodyear Tire and Rubber. And this one has that breakdown. And look at what we've got here. We don't have any inkling of where support lies because this is the lowest we've seen Goodyear Tire and Rubber this whole year. We have the PMO sell signal getting lined up. And again, going to a weekly chart, that's where I would go to find the various support levels. 24 looks like a pretty good area of support. So we're not necessarily going to get a huge amount of downside. But when I look at these very negative PMO, that the 17 and 43 week EMA negative crossover, I think you could look for a move further down to the 22 level and maybe even down to 18. So I think that has some clear bearish bias on that. International Flavors and Fragrances got the breakdown below that declining bottom, or I'm sorry, rising bottoms trend line, and also broke below this area, I would say, of fairly important support. Currently, it is now trading toward its intraday highs, and you can see the PMO did sort of tip upward. That's happened since I did my scan, because every one of the scans I did, the PMO is topping. So maybe this one isn't quite as enticing as far as a bearish play, but a move down to 132.50 sure seems really likely, highly possible, and maybe even down here to that 130 level. But I'd be watching that PMO to see if it will still hold that negative energy. And finally, we already have the breakdown on Johnson Controls. We see the PMO is about ready to give us that PMO sell signal below the 0 line. And again, where is my support levels? Because I can't see them here on the daily chart for the last year. So I'm going to go back to the MarketWatchers weekly version. And I think you could make a case for some support here at that 32 level based on that drop. But honestly, I would look more toward that $26 level. So I think there's certainly a lot of downside potential when you look at Johnson Controls. And that completes my chart breakdowns. What do you have for us, Tom?
All right. Well, I thought maybe I'd take a little different look at predefined scans. Maybe just kind of point everyone in a direction where you could maybe find some breakdowns. So let's start with that page. So let me grab the screen, and we'll go through this pretty quickly here. But here you can see from the member dashboard, if you go down toward the bottom, you'll see the predefined results. Here are predefined scans. So I'm going to start there. And from there, you have these different technical indicators. So all these scans have already been run for you. And under the bearish technical indicators, I know we don't talk about the commodity channel index much, CCI, but it is a momentum oscillator. And you can see that there are stocks here, 541 of them, that have new CCI sell signals. So just kind of introduce this concept. Let me go ahead and pull up. I'm just now from the columns, you can see the various indices. I'm just going to go with the New York Stock Exchange here, just to limit it down to 165. So we'll go ahead and pick that. And as I know you've shown before, Erin, you can click here to edit the scan. When I go down and look, here's stock 69,000 shares, 68,000, only 9,000, 23,000, 52,000. I want to get rid of some of these that just aren't trading much. So let's go ahead and click here to edit. And very simple. You already have all the parameters set for you. But if you wanted to change something like volume, if you click here and then just click add, it'll go in with predetermined 9,999,999. I'm going to change that. Let's just look at stocks that maybe have traded over 300,000 shares. And then maybe one other thing. Let's look also at scooters. And I don't want to get a high scooter stock. So let's do scooters have to be less than 60. And let's just see what this returns. So you can check the syntax, make sure everything's still good, which it is. We run the scan. Hopefully we have a few. All right, we got 59. So we really cut down quite a bit on the number. Then what you can do is once you have this, you can replace it into an existing chart list. So you already want to have or you can store it in a new chart list. I already have one set up. So I'll go ahead and just drop it into the scan results other and click it. And that should take me into scan. Now I've got all these in this beautiful chart list. So do any of them set up possibly for a look to a 10 per page? This is pretty neat too. You can look at the list based on these different things. We could even do candle glance. Maybe that would help us pick out some very quickly. But you can see Ambev looks like maybe breaking down below some key support. You've got another one, Agco, which is getting close to a support level. Let's see if we've got any others. Well, AO Smith, AOS, it looks like it's making a breakdown. It's either going to have a reversing candle with false breakdown, or it looks like it could be making a breakdown. But I'm just quickly looking through this list to see if anything is appealing. Here, COF Capital One, threatening a breakdown, but again, maybe it leaves a long tail below the price support. Maybe we get a recovery later, hard to say. But this is just a different way maybe to look for chart breakdowns rather than actually give you the breakdowns. These are just some possibilities. And then you can take a look at them. Again, because you do it in the candle glance, you're able to look at a lot of stocks very quickly. Look at HFF. Clearly, this is a breakdown. We'll pull this chart up in just a second. I just want to see if there's anything else that looks kind of interesting. NYCB, Community Bank. Also breaking down. Morgan Stanley threatening a breakdown. But all of these came off of the CCI predefined scan. So there's so many different ways to use stock charts. But let's go back up and take a look at that HFF and see what the chart looks like. Okay, so we had a nice uptrending stock. All of a sudden, it's down 17%, but this is a clear breakdown. Now, just like chasing to the upside, I'm not a big fan of chasing to the downside, but it does look like the stock has now broken down. So what I would be interested in is at some point, if we make a move back to the upside, if this breaks down below, say, the 50-week moving average by the end of this week and trades down for a couple of weeks and then comes back up and tests that 50-day from underneath, that could be a great opportunity, perhaps, to go on the short side if you're interested in shorting. It did have a nice uptrend in play, higher prices. Look at that negative divergence on the PPO. The PPO had rolled over even though prices were moving up, and maybe that was a little bit of a precursor, just a sign of some slowing momentum. So really, that's just what I wanted to show you. There's a lot of different ways to approach breakouts, breakdowns. This was just another example of how you could use that predefined scan tool here at Stock Charts to find some great candidates. And with that, let's go ahead and summarize the chart breakdowns. You can see Erin went through a number of stocks, and then I showed you the predefined scans, how you can kind of work through that to find potentially some chart breakdowns or some bearish setups. And specifically, you can see AOS, COF, and HF were three that I had discussed. So I think that's pretty much it for today's show. It was awesome having Gatis Roze back on, or on, I shouldn't say back on. That was our first time having Gatis on the show, and he offered up a completely different approach in terms of maybe showing a little bit more of a long-term tendency to buy and hold many stocks as long as they continue to outperform. So I thought that was great.
Yeah, absolutely. It's something that we don't always cover, the intermediate to longer term. And I know we had a lot of investors out there probably very interested in what he had to say. And I do recommend you go to his blog, The Trader's Journal. You'll find it just under the blogs tab, and you can get to all the articles he's written. So you can go back toward the beginning if you wanted to look at some of the earlier articles to help get your feet wet. Lots of information there.
Awesome. Well, I guess we are about to wrap up. We do have some interesting things left this week. Why don't you go through those before we?
Sure. Well, tomorrow is my workshop on moving averages. I'll talk to you about the various kinds and the different things you can do with them, especially our decision point trend models that use them. And then on Friday, we will have everything stock charts. I still don't know the hint of what they're going to go through, but I'm sure it will be very exciting. I always love to see the everything stock chart segment because I always learn something, honestly, that I didn't know. The website is just so full.
Mm-hmm. There is a ton of information. I mean, again, we just scratch on the surface. It's always great having Chip and Bill Shelby and Grayson Rose coming in from time to time to go into something more in depth. And as you said, I've always learned something new, something that I didn't realize I could do. The one thing that I'm really weak on are the shortcuts, being able to find certain things because I'm not that computer savvy. I have to do it the long way. It is what it is, right? I do want to say, though, that we did with the market before we leave today. We've got the Dow Jones Industrial Average right now down 52 points, but it does seem to me like it's in a bear flag off that selling yesterday. Not looking great. I don't want to see it break to new lows this afternoon, but anyhow, that's where we stand right now. I want to thank everybody for being with us today. Again, special thanks goes out to Gatis Roze for joining us. Please remember to complete the survey as you exit. We'd like to get your feedback, what you thought of Gatis's presentation, and also what you think of Market Watchers Live. Market Watchers Live airs 5 days a week, Mondays through Fridays from noon to 1:30 p.m. Eastern Standard Time. Have a great Wednesday afternoon, everybody. We'll see you back here tomorrow on Thursday. Happy trading.